Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to answer the question, how can we be confident that our approach to investing is a good one, particularly when maybe we're losing some money? This question came in from a viewer named Amy. Let me read you some of her emails. She says, I've been watching your videos and really enjoying them. I'm learning so much. Thank you. I'm hoping you could offer some guidance. She's 51. She's just started in saving and investing for retirement. She is single with children. And she says she chose VTI and VXUS. We'll talk about what those ETFs are in a moment, for a Roth IRA at Vanguard. She funded it for 2021 and 22 for a total of $14,000. She says, I started saving and I am down by $800. I understand the concept of buy and hold, and historically it should improve. It's just that I need a reassurance that I'm buying and holding onto the right ETFs. My plan is to keep adding as much as I can. I'm thinking it's time to open a brokerage account and continue with VTI and VXUS. Is this the best that I can do? Am I doing something wrong? Can I do anything better? She also mentioned a tax return that she might use to fund a Roth IRA. She says, I'm happy to say that I have no debt, which is obviously very good. She then added this. She said, I didn't want to ask these questions on your live YouTube show. The others talk about investing their millions, and I feel a little out of place. Thank you for any suggestions and all of the videos. Well, Amy, that is a great question, and frankly, it's an issue that I have given a lot of thought to over the years. It's one thing to tell folks, pick a few low-cost index funds, perhaps a 3-fund portfolio, and basically bet your future on that 3-fund portfolio or 2-fund portfolio. But that might be easy to execute, but how do we do it with confidence? How do we know, yes, we're doing the right thing, particularly when the market is down? Now, I'm going to address that. I do want to talk about the last part of your email to me, and I get it. But here's the thing to remember, is that I don't care how much money someone has or how much they tell you they have, if they tell you that at all. We all started at basically the same place, except for, I guess, those people that inherited a lot of money. My very first investment, now this was in 1993, I think, was about $100. That's as much as I could afford back then. But that's what I invested. And we didn't have much money. We had a lot of debt. I basically graduated college with about $55,000 in debt, and that was, a lot of money today. It was really a lot of money, almost 30 years ago. But you just start with what you have, and that's how everyone begins. Again, unless you inherit a lot of money or you win the lottery. So we should not feel bad where we are. And frankly, you've obviously done a lot of homework, thought a lot about your approach, and I think your approach is sound, as we're going to talk about. So we're going to look at your approach, VTI and VXUS. And we're going to sort of talk through not only the approach, but how can we think about it in a way that might give us confidence that what we're doing is a solid approach, given the fact that none of us know the future. We don't know what the future returns are going to look like, inflation, we just don't know these things. But how can we have confidence that we're making the best decisions we can with the information we have? And so to do that, I want to begin by just taking a quick look at VTI and VXUS. These are funds we've looked at a lot on this show. We're going to start with the VTI. So that's just the ticker symbol that I'm referring to, VTI, which is a 1 to 5 letter symbol that is unique to each stock or mutual fund or ETF. This is an ETF, and it's from Vanguard, and it simply basically mirrors the total U.S. stock market. And the thing that I'd like to point out about it, we're in Morningstar, and we're at the Portfolio tab. And I want to come down here to the Portfolio, and you can see this one ETF holds over 4,000 companies. So you invest in VTI, and Vanguard takes your money and spreads it out, doesn't spread it out evenly over those 4,000 companies. This is what is called a cap-weighted index, meaning the more valuable the company, the more it gets of each dollar you invest. But it covers 4,100 119 companies, and we can see the top companies here. It starts with Apple, which is the largest company by market capitalization by value, and Microsoft and Amazon and on down. And we can look at the top 25 here very easily. But the point is, in this one fund, you are covering the entire U.S. market, which I personally think is an excellent way to invest in, effectively, the United States of America. It's what you're effectively investing in. And it's very, very inexpensive. We can see that if we come back up and go to the quote tab here, we will see that the cost is just 3 basis points, 0.03%. So it's very, very, very inexpensive. So that's VTI. And your other fund, VXUS, here's the symbol, the ticker symbol. It's the Vanguard Total International Stock ETF. You could think of this as sort of investing in everything outside of the United States. And if we come down to its portfolio, we can see that this owns over 7,800 stocks. So again, extremely diversified. And if we come back up and we go to the quote page, we can see that it too is very inexpensive. It's a little bit more, but not much, 7 basis points. So the first sort of thing I want to emphasize is that for the stock portion of a portfolio, investing in VTI and VXUS is about as diversified as you can possibly get. As you saw, we've got 4,000 companies in one, 7,000 companies in the other. So just from 2 ETFs, both of which are incredibly, almost free, not quite, but almost free, you've got over 11,000 companies. And so you are about as diversified in a stock portfolio as one can be in just 2 funds that are incredibly inexpensive, which is why these funds, I think, are so beneficial to investors. And I think really, personally, I think these should represent the core stock portfolio for anybody. And they can, as they do in Amy's case, they could represent the entire stock portfolio. Frankly, I don't think you need anything else. I understand some folks want different kinds of exposure beyond these 2 funds. That's fine. But you've got total exposure across, frankly, the globe in just 2 really inexpensive funds. I personally think it's a great way to go. However, we now have to look at reality. You're excited, you put your money in VTI and VXUS, and as Amy points out, it goes down. That does happen. That happens with any investment. We've seen that this year. It even happens with safe bonds, right? But let's take a closer look at that. So let me show you Portfolio Visualizer. And what I've done is I've put VTI and VXUS into Portfolio Visualizer. This is a free tool that can help you analyze, among other things, how investments have performed in the past. Portfolio Visualizer, in this case, only has about 12 years of data, or excuse me, about 10 years of data for these 2 funds. It actually has a little more for VTI, which we'll look at in just a second. And so if we come down to the performance, we can see that for the most part, these 2 funds have done quite well over the last 10 years. That's because, as you probably know, we've more or less been in a bull market for that period of time. We're going to extend this in just a minute. But the point I want to make here, though, is even in a bull market, we've had some bad years. Of course, we can look at 2022, where VTI is down 14%, international is down about 12%. But we can go back to 2018. VTI was down 5%, international was down 14%. We can see some past years where international was down. And if we remove the international for just a moment, we'll actually get more data on VTI. It goes back about 20 years. This goes back to 2002. And if we come back here and we look at the years, we can see 2002, a bad year for VTI, for U.S. stocks generally, was down 20%. 2000, 2001 were also bad years, except the data doesn't go back that far. Look at 2008, 37%, it was down, right? And if we can just make it seem like things are even worse, we can come over here, and in this case, what I tested was not VTI and VXUS, but the asset classes that these 2 funds represent, the U.S. stock market and the global market. And I did that because in Portfolio Visualizer, if you look at asset classes as opposed to specific funds, you get more data. They basically cover the same thing, but now we can go back to 1986. And I do that to show you that we can see other bad years. For example, now we see all of the 2000 to 2002 time period. So you imagine living there. It's one thing to look at it now in hindsight and see, oh yeah, 3 bad years. But imagine living through that day by day, which of course as an investor I did. It was not a fun time. And you can see the market was down significantly each of those 3 years. 1990 was a terrible year for international stocks, but also a bad year for the US market. And of course, we all remember 2008, where the markets were down significantly. And this really hides the fact that from a point in 2008 to early 2009, into March of 2009, because this looks at it annually, but from a period in 2008 to March of 2009, the US stock market was down 50%. Now, why am I pointing all of this out? It's almost like I'm trying to scare people away from investing. There's a couple of reasons, and I think this matters when it comes to being a confident investor. The first thing we need to understand is that bad markets are normal. They just happen. Fortunately, they don't happen all the time. They don't happen every year, but they happen pretty regularly. And of course, we could go back even further in time, and we could look at the Great Depression in 1929 to 31 was a bad year. The late 30s were a bad year. There were bad years in the 60s and 70s. So this is a very normal part of the process, and we should come to expect it. We shouldn't see this as something is wrong, I guess is really what I want to say. We shouldn't see a bad market, like we're kind of having now, I guess, as something's broken, that something's not working. Actually, frankly, it's a sign that something is working, that the market is working, and it's going to have its natural ups and downs. They may not be a lot of fun, but it's reality. That's the first thing. The second thing, Amy, I would say, it doesn't apply to folks maybe older, like, in retirement, but when you're still accumulating, when you're still saving money towards retirement, which you are, you actually kind of hope for market crash. I know that seems odd because you're going to, log into your Roth IRA there at Vanguard and you're going to see the balance go down. But it's actually the best thing that could happen for folks saving for retirement, because when you make your Roth IRA contribution, say for 2023, or as you mentioned, you may open up a taxable account, a brokerage account, and invest more, you're buying your shares for less and less money. As the price of VTI and VXUS go down because the market continues to go down, you're able to make investments for cheaper and cheaper amounts. And that's what, for the long term, will be the best for you. Really, the last thing you want is for the market to continue to go straight up. You want it to go straight down while you're accumulating, while you're saving for retirement. And it's not fun during the moment, but a couple of things are going to happen. Not only are you going to be investing for lower and lower costs, but when your funds distribute dividends and those dividends get reinvested, they're going to get reinvested at lower and lower amounts. And when the companies that are held in VTI and VXUS buy back their own shares, which companies regularly do, they're going to be able to buy them at cheaper and cheaper prices as the stock market continues to go down. So actually, you shouldn't see it as a problem. You shouldn't see it as evidence that something is wrong or that you're doing something wrong. It's a natural part of the process. It happens over and over again. It has, and it will continue into the future. But for someone accumulating assets, it can actually be and is a very good thing that will help you build more wealth. In fact, I would say significantly more wealth than if the market just continued to go up. Now, I want one big caveat to all of this. Your investment portfolio, and it's the kind of a portfolio that I personally have used as well, not exactly VTI and VXUS alone, but very similar to that. These are a broad-based, well-diversified, inexpensive portfolios. You're covering the entire market. So when your investments go down, you know the reason they're going down. They're not going down because the manager of your fund did something wrong. They're not really doing much at all. They're just mirroring the markets, right? So they haven't made a mistake. They haven't lost their way. They haven't taken an investment approach that turned out to be a really bad move. You know that when your investment portfolio is down, it's down for one reason and one reason only, and that's because the market as a whole is down. Now, For folks that get fancy with their investments, maybe they invest in actively traded managed funds, for example, or they invest in funds that have a very unique and specific approach to investing. When those types of funds are down, you do have to start asking questions. If you're an investor in ARK, and folks know I've not been a fan of Cathie Wood's approach to investing, but that being said, if you invest in ARK, the fund has been down significantly. You now have to start asking some really important questions. Is her approach to investing the right approach? Is ARK, is it investing in the kind of companies that make sense for long-term investors? Now, you may conclude, yes, you think that the approach is a solid one, but those are the kinds of questions you have to be asking. But for those of us that invest very similar to the way Amy does, where you're just investing in broad-based index funds, we don't have to ask that question. We know that's not the reason the funds are down. They're down because the market is down. We know the market goes down from time to time. That's a regular part of the process. History tells us that. It will have good years and it will have bad years. So for me anyway, a combination of understanding history, of understanding that when the market is down, if you're still saving for retirement, it's actually the best thing that could happen, because your investments that you make each month, quarter, or year buy you more and more shares, and knowing that you have invested in a very broad-based sort of index fund approach, meaning that if they're down, it's not because the manager has made some tactical error or bad decision. It's just that the market is down. At least helps me have confidence that the approach I'm taking is sound. So Amy, that's my response to your question. I think it's an excellent question. Frankly, I can assure you, Amy, I don't care how much money someone has. Every investor is asked in some form the very question you have. I can tell you I've asked it many times over the last 30 years. And it's ultimately, frankly, Amy, the question you asked is ultimately what led me to the type of investing that I do today. Because when I first started investing, that initial $100 was in a fund called Legg Mason Value Trust, which was an actively managed fund run by a famed investor, Bill Miller. Very smart guy, very good investor, had a 15-year run where he beat the S&P 500, and then, well, he didn't, and the fund kind of blew up. But it was during that 15 years where I asked myself, how can I be confident that he's doing the right thing? Even as smart as he is, how can I be confident that I can follow this approach to investing, not for the next 5 or 10 or 15 years, but for the next 30 or 40 or 50 years? And I concluded I couldn't, and I actually got out. Fortunately, it was before his fund stopped beating the S&P 500, but it was what ultimately led me to putting most of our investments in low-cost index funds that simply mirror the market. So there you go. I hope that helps. If you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. Until next time, remember, the best thing money can buy is financial freedom.